Hi folks, let's talk about financing a CNC machine or really any purchase or asset. Let's talk about the mechanics of how the loan works, and then let's walk through some of our advice and tips and things to avoid on the terms of the loan and how you should approach financing a machine. For those of you that have followed our story at NYC CNC over the years, you guys know I'm actually not a big fan of debt and pretty vehemently against it, and have generally been a believer of folks like Dave Ramsey, who really preach to not live beyond your means and not live in a world where you think debt is okay. And that includes everything from credit card debt to financing machines and cars and so forth. Nevertheless, I'm not here to preach. I want you to be smart. I want you to make good decisions. And I want you to realize that the banks and the lenders, they're a tool, but they're not your friend. You've got to be sharp. Let's talk through some do's, don'ts, and absolutely key advice if you're going to borrow money. So let's say we want to purchase a CNC machine and the total purchase price is going to be $175,000. That may be just the machine, or it may be the machine plus a tooling package, plus even some rigging costs and so forth. You're going to need to make some amount of a down payment. The higher the down payment, the more your lender is going to like you because it represents lower risk to them. And we'll talk more about how lenders view down payments and overall risk profiles of a borrower. How much down is going to depend a lot on your profile. How credit worthy are you? What's the sort of machine that you're buying? What's it being used for? Your business financials and so forth. There are situations where companies will lend with $0 down, and there are some situations where they may require 30 or even 50% down. A generally safe number that you're going to want to see is 20 to 25% though. In this case, let's say it's $45,000 down. It's about 25%. So if we're purchasing a machine for $175,000, when we close that deal, we are going to come to the bank and bring a check ourselves of $45,000 cash. That means we're financing or borrowing on the difference, which is $130,000 in this case. The two other major factors in a loan: what is your interest rate and what is the amortization period? Interest rate, most people know and are familiar with, and that's simply what's the interest rate the bank's going to charge you. Amortization is the years over which it would be fully paid off. And this is one of the really important lessons is I'm going to recommend to make sure that your amortization period matches the term of the loan. In other words, at the end of the 5 years, you have a $0 ending balance, you own the machine, and the loan is gone. There are situations where the amortization doesn't match the loan term. So let's say, for example, that this loan only lasts for 5 years. So the bank's going to give you money, but at the end of year 5, the loan is over. If they amortize it over 15 years, though, take a look at what happens to our monthly payment. It goes from $2,483 down to only $1,000. So this looks great. I only have to spend $1,000 a month and not $2,500. But if you go down month 60, the end of this loan term, your loan that started at $130,000, you still owe $97,876. This is what's called a balloon payment or a non-fully amortizing loan. And this is really bad because the lender has every right to call you and say, you owe us 98 grand or you need to refinance this loan. So we'll save it at that. But really, you want the loan amortization period to match the term. And for CNC machines, tends to be relatively short. Things like 3 years or 5 years or maybe 7 years. On things like real estate, if you're perhaps buying a building for your shop, you may well be able to get to 15 years. And the reason has to do with what is the collateral? What is the bank lending against? Buildings and real estate, it does depreciate. In other words, every year it's worth a little bit less because the building gets a little bit older. But buildings and real estate tends to depreciate a lot less than a CNC machine. CNC machines are kind of like going out and buying a new car. As soon as you drive it off the lot, it's probably lost 20-30% of its value right out of the bat. And for most of us in our lifetimes, real estate has tended to often actually appreciate, and that has to do with external market factors and drivers of demand and growth. So you can't always rely on that, but nevertheless, it's why you're going to generally see more favorable interest rates on things like real estate or hard assets and not quite as good terms on things that are riskier like CNC machines. So once you have an interest rate, the loan amount, and the amortization, that will tell you what is your monthly payment each month. And in this example, it's $2,483. Well, so what is that amount? That's not interest, it's not principal. It's actually a sliding scale, a mix of both. So let's say we close this loan at the beginning of June. At the end of that first month, you'll have made one payment. And of that payment, $596 is interest, and $18.87 is principal. But what's kind of cool about a loan amortization schedule is every month it shifts a little, and that's because every month part of your payment goes towards principal paydown. That reduces the loan balance. So on, say, month 10, your payment is the same. Notice the sum of interest and principal is still $24.83. But whereas your interest in the first month was $596, now you're only paying $517. So if your payment is the same, but you're paying less interest, that means more of your payment is going towards paying down the loan's principal. And that's why if you look at the interest payment as a percentage of the monthly payment, it starts out at 24%. But as you go down the loan schedule and you move towards paying off the loan, you'll notice it drops down and eventually, again, on your last payment, hits zero. And one of the things I will say, though, is if you do get a loan, I would really encourage you to have the ability to prepay that loan. And that means the option of both prepaying the whole loan if you happen to do really well, or you somehow come into some more money and you can get rid of that loan or pay that machine off, or just making a little bit of additional payments each month. So we've set this spreadsheet up to show that. Let's say that you're comfortable buying this machine, you've got the $45,000 down payment, and you know once that machine is up and running, or maybe even already, you can afford a $2,500 a month payment. So you're thinking, okay, this is good. I need this machine tool. It's going to make me money. It's really a key part of my business, but I really don't want to be stuck with this loan for 5 years, especially if I think I can really crush it and outperform it. So let's say you think you can afford an extra $1,000 each month. Let's take a look at what that does. Notice right now I've got this formula here that calculates the total interest over the life of the loan. So right now, under our normal loan scenario, we're not prepaying any of it. We're going to borrow $130,000, but we're going to pay about $19,000 in interest over those 5 years. If we're able to make an additional $1,000 payment each month, so I would say negative $1,000, and let's copy that down through here. We're going to pay that loan off right here. Month 43, that's 3.5 years versus 5 years. And look what that's going to do to total interest. It's going to cut our interest down to $13,000. That is awesome. And the way I've set this spreadsheet up is how I treat our loan. We do have a loan on our building here at Saunders Machine Works, and I try to make an additional payment each month that we're comfortable hitting. And then if we've had a good month, I'll try to even make yet again another additional payment that's going to even help further reduce it. Let's say every few months you get a good job that comes in and that lets you make a larger payment, say $3,500. Boy, you do that a few times and you can see how much quicker you're going to get this loan paid off. Let's talk about some other tips, tricks, and things to think about when you're talking to a lender or talking to a bank. Number one thing is, again, if possible, ask or make sure you're allowed to prepay the loan and without a penalty. You might think, well, why would there be a penalty? You got to look at this from the lender's point of view. If they're going to go to the hassle of creating a loan and taking that risk to you, they actually really want to earn that money. They want to make $19,000 off of you. So if you overachieve and you pay this loan off really quickly, they're going to earn a lot less money. So some banks and some lenders really don't like that, and some will never allow you to prepay, or else there's something called yield maintenance or make whole, which I would really try to avoid. I want to be able to prepay it, and I would really prefer to prepay it without any penalty. Number two, understand and ask your lender what, if any, fees will be involved in originating that loan. There may be paperwork fees, there may be an actual origination fee, and those can add up. Make sure that loan fully amortizes over its term. You do not want to end up with what's called that balloon payment, where the term of the loan is over, but it's not paid off. You can really end up in a bad situation because you either have to come up with the cash, you have to refinance, or you're going to default and they're going to come take the machine and maybe even more. Number four, somewhat ironic, but the better your credit is, the better your personal finances are, the better your business is, the longer your businesses have been around, the better your financing terms are going to be. This is a tough one because a lot of times the company that needs to borrow the money the most is the young company or the young person or someone who's unproven, and they don't have any other clue how they're ever going to get a machine, and they desperately want to borrow money. You're going to get the worst terms, you're going to get the worst interest rate, and you're going to have the hardest time negotiating. It's one of the many reasons we also really disagree and really don't recommend debt. Much prefer taking your time, starting small and growing. And the irony is that sometimes companies that are very healthy and successful will use financing because it's so attractive to them because they're in such a strong financial situation. Number 5, know what is what's called recourse or secured against your note or against your loan. What this means is, what can the bank do if you default? The best situation would be it's just the machine. In other words, I could default, I could stop making payments, and all the bank can do is say, we're coming to take that machine back. The next best option would be it's secured against your whole business. So if you stop making payments or you default, they're going to come take the machine, they're going to sell that machine, and then your business is still going to be responsible for whatever they have lost against whatever your current balance is. So again, if you defaulted after the first year, your balance is $106,000. They're going to repossess that machine. They're going to incur some fees in doing so and rigging. Then they're going to sell that machine, and they may only sell it for 70% of what your current loan is. So if they sold it for $75,000, let's say they had $5,500 in fees, and trust me, there will be fees from lawyers and rigging and costs and so forth, then you're going to owe $106,000 minus what they sold it for, but plus the fees, you're going to owe $37,000 in that scenario. And they're going to be able to come back, and if your business has secured that loan, they're going to be able to take or get a judgment against other business assets you own. Could be other machines or other equipment or actual cash held at your business. And then the worst would be personal assets. This would be a personal guarantee, and it's important to understand this can include your personal house. And this is really important to mention, because this is how debt can really ruin your life, is if you don't realize it, and maybe it's for reasons outside of your control. Let's say there's a fire. Let's say insurance doesn't come through. Let's say there's a devastating economic downturn. The bank can actually come back and say, you owe us that $37,000. And if your business can't come up with it, we are going to force you to sell your personal house. That can happen, and it does happen. If you are able to get the lender to just secure the loan against the machine itself, in other words, again, you could default, but all that the bank can do is come back and take the machine back, repossess the machine. If they lose money because the machine is worth less than the loan, that's on the bank. What they can do is have what's called a bad guy or good guy clause, where if you act really irresponsibly, that could trigger full recourse. In other words, let's say you do default and the bank says, well, guess what? You owe us the machine. Well, if you go and you then intentionally crash the machine, or you do something that's really fraudulent, I'm talking really bad, then that could trigger the loan to go full recourse back to your business or your personal assets. That would all be laid out in the loan documents. Number 7, really important that you read and you understand what are called loan covenants. Loan covenants are obligations that you as the borrower have each year to keep the loan what's called current. So keeping a loan current or in good standing is more than just making the monthly payments. It means you also have to comply to other obligations or covenants. They may be as simple as keeping the insurance in place, or they may be more complicated. We've seen and heard of situations where there are covenants with regard to business performance, where you have to maintain a certain amount of revenue. Otherwise, you've violated that covenant, and the bank will say you either need to fix that and get it back to where it was, or we're going to talk about calling this loan or putting you into default. Number 8, avoid prospective default language. And that's where the lender can use their discretion to put you into default or call a loan early if they think you might be facing a default. And if this sounds crazy to you, I think it is crazy, but we actually saw this in a loan doc and we insisted that it was removed, because I am never going to let a lender look at our financials and say, boy, I don't know if I like where this business is going, or I'm not sure I like where this industry is headed. I want to end this loan. Absolutely not. It honestly blew our mind that this language existed. What was even more shocking was we were told that we were the first people to ever ask that that language be stricken. But I'm never going to allow a lender to use their own discretion to put me in a default, nor am I ever going to let a future event that hasn't even transpired yet and may not transpire be reason to today call that loan or put you into default. Absolutely not. Similar to ongoing loan covenants, know what the annual obligations are of a loan. You may have to share certain tax documents. You may have to share proof of insurance or revenue numbers and financials, and you may have to do so on a timely basis. Again, know what they are and be prepared to meet that obligation. Number 10, absolutely 100% of every deal term has to be in writing in the loan documents. What I mean by this is anything that you think is part of the loan, if it was said verbally, if it was written over an email or in a meeting with the bank or the lender, it does not matter unless it's in the loan documents. And I emphasize this because we've had situations before where a bank has said, oh no, we're on the same page. That's what we mean. But it wasn't what the paperwork said. And by paperwork, I don't mean emails. I mean the actual loan documents that you sign, and everybody gets a copy of it closing. And one reason I insist on this is because bank employees come and go. They move, they retire, they go to different jobs, different banks. Loans can actually be sold, and that may sound like a funny concept, but banks can actually sell a loan to another bank, and banks themselves get sold. And what can happen is the person that you had that casual understanding with may no longer be in the picture, and the new player, the new employee, or the new bank may not see eye to eye with you on that verbal agreement or even that email. Number 11, it's worth noting that some machine tool dealers are able to do in-house financing. That may be through a third-party affiliate that they have a working relationship with, or it may be the owner of that machine tool distributorship or company that's able to offer their own financing. And those could be great options because they're familiar with the assets, they're familiar with the machines. They may be more willing to take a risk because they know what they're lending against. They understand the collateral, and they're probably going to be more in tune with the business model and operations of their borrowers. And that's a good segue into number 12, which is if you're going to get a loan, it's important to understand the loan from the bank's point of view. How does the bank underwrite a loan? And their view, broadly speaking, is that they know a certain number of businesses are going to fail. And they may fail because they're poorly run businesses. They may fail for personal reasons of the owners of the business, or it could be unrelated and out of their control, just based on a broad economic changes, or a recession, or a downturn. What the bank cares about is what is their collateral and how expensive is it for them to recover that collateral and avoid losing money. Again, going back to our example, after 1 year, the $175,000 machine only has a loan balance of $106,000. So you might think at first, hey, that's pretty good. I paid $175,000 for it, and the bank, I only owe the bank $106,000 for it. Well, it's not necessarily that great because that initial price may have included some things like rigging, soft costs, some tooling, and that may all be sort of gone. So let's say that was $15,000 of that initial price. So that leaves us the $160,000 price. But let's say that machine tool really loses 30% of its value the day it walks out the door. So let's say times negative 30%. So now we've got something that's worth $112,000, but let's say it's got some wear and tear on it, and that's another 10% off. All of a sudden, the actual cash value of that machine is actually pretty close to or even less than the current loan balance. And the problem is that the bank has to go, they have to rig that machine out, or they've got to bring in a third-party auctioneer or company to sell that machine, and they're going to take probably a 15% haircut. So you can see how the bank is going to look at that and think about what's the risk profile of the machine, what's the risk profile of the borrower, and how likely am I going to, number one, get all my money back, and then number two, earn some interest on that loan. And lastly, lenders will generally prefer to finance new machines. Again, that goes back to your credit profile, your business history, and the lender's familiarity with the industry. If you're using an in-house lender from a machine tool distributorship, they may be very comfortable with a used machine that they brought in and they cleaned up and serviced, and they know it's good collateral. But generally, it's difficult to finance used equipment. Some pitfalls and mistakes to avoid. Again, I want to re-emphasize, do not rely on any information or any deal terms unless they are written into the official loan documents. End of conversation. Number two, make sure your loan has what are called clear notice provisions if there is a default, along with ample time to cure. The simplest example of this is, let's say your payment gets lost in the mail. Instead of the lender immediately putting you in default and potentially charging you huge penalties as well as calling the loan. Calling the loan means they say, game over, you need to repay this whole loan today. They need to give you a notice. They need to say, hey, you are going to be in default unless you cure or fix that mistake within a certain time period. Now, these can be pretty tight provisions, and there may still be some penalties involved if you say missed a payment, but nevertheless, Whether it's a financial mistake or the check got lost in the mail, or let's say you fail to meet one of your ongoing covenants. Let's say you've switched insurance companies and you accidentally had a gap and your lender finds out for some reason that your machine wasn't insured. They need to notify you and allow you to fix that. And then lastly, just beware. One of the enticing things that lenders will use are various different games and shenanigans to make you think that the loan is better or cheaper. It's not. Getting a zero interest up front or a grace period can be a great thing or sounds like a great thing. You think, hey, I'm able to get this machine in. I don't have to make as much payments. I don't have to pay as much, or I don't have to pay anything for 2 months or even 6 months. But just know at the end of the day, you're still paying for that, and it's going to get baked into your interest or your overall payments somehow. If you've enjoyed this video, whether you're a machinist or a manufacturing entrepreneur, check out the NYC CNC website. We've got content for you on everything from CAD and CAM tutorials to business advice, entrepreneurship advice, and how to succeed, make money, and be happy and enjoy what you're doing.